I felt okay that we should be going back to basics and trying to understand the process, okay, which we all work out of. So what I want to basically say at the start, at the very onset, is that this is the first of a few programs we have devised over here at vTrender and organized so that, okay, you collect maximum information from the markets. Today we are going to be starting on the market profile. I intend to go on to options flow, understanding second order Greeks, the spectrum, etc. On the tweet I made yesterday. It's a very important part of our market today. Then we'll speak about order flow. We'll begin with the basics for all of these things. So we'll talk about the basic things which are required. In the nitty-gritty of markets, some of these basics get lost on us. So we're going to be speaking a bit more about how to approach the information the market is giving us. And our core strength over here is market profile and order flow. And we are going to restrict it to our understanding of market profile and order flow using options as the tool in which we trade out of. This is how we trade it. Not a lot of us do the futures anymore. So the work is always done through the options market. And as I've been pointing out, it's a very big market today, 50,000 crores daily. And that's daily in premium turnover every single day. That's the size of this market. And there is a lot of information coming to us in this market every single day. So our effort over here would be to find out what the market wants to tell us. And every single day, the information the market is giving to us is going to be different. And we're going to be making the absolute best attempt to find out what the market is telling us at any point in time. So I basically work with the market profile. It's something I understand dearly. Now, just a disclaimer over here, there are 100 ways of making money from the markets, and every single thing is good, provided the end result is that you make money from the markets, right? So I talk to you about market profile because this is something which resonates with me. This is something, okay, which has worked for me. And I only like to talk about what has worked for me, right? What works for me, I feel, okay, is good. I am competent at it, and I'm going to be talking to you, right? So on your screens right now is a market profile chart. And we basically come in together to understand what this market profile chart is telling us. I'm back, okay, with the chart. So what we do is like we work a lot out of candles in particular. In fact, let me keep the price back over there. This is our basic candlestick chart. And this has always given us information about what the market is intending to do. Now, this has served us for a number of years. But what really happened in the early 70s, and I'm talking about 50 years back, in the late 60s, early 70s, a gentleman came along by the name of Peter Stedelmeier, and he devised a method, a mechanism to get a little bit more from the market. So at that point of time also, a lot of these candlesticks and these PNF charts and all are very, very popular, and a lot of traders, okay, had used them. But he said, okay, he wanted to get a little bit more information about the role the buyers were making in the market and the sellers were making in the market. Now, Stedelmeier was a pit trader. And by definition, a pit trader is somebody who's worked very closely at the heart of the market. Now, I'm not sure, okay, if a lot of you have watched the Harshad Mehta series on Dalal Street, where earlier in that series, he's there on in the stock exchange, the Dalal Street, and he's there on the floor of the exchange. And he's speaking to a large group of people, and they are exchanging, all of them are talking loudly and at the same time, and they are talking about the various stocks for buying and selling, and they go to each other and speak to each other and try to communicate and try to broker a deal at that particular floor on that particular instrument. This is how trading used to happen years back, and I'm talking about 50 years back, till the electronic markets came in, and electronic markets changed everything for us. But essentially, what really used to happen was a system, okay, where there was human interaction, and the people, okay, who were dealers on the floor, they had information at that fingertips, and they knew that a certain gentleman has told them in the morning that he wants to sell, and they knew, okay, that security needs to be sold, and his job was to find buyers for that gentleman who's told him that I want to dispose of this security. So they, armed with information, became powerful players in the market because they had the power of information on their side. And Pete Stedelmeyer knew about this concept, and he was trying to devise a system where he could duplicate what was happening on the floor of the exchange and put it on a chart such that traders could utilize it okay, for their own benefit. Fast forward 25 years later, he devised the market profile. They traded it on the exchanges in Chicago. 1992-94 onwards, a gentleman by the name of James Dalton joined him, and both of them have been pioneers of this concept called the market profile, and they've given us this chart, okay, which is there on your screen, the market profile chart. So what basically it does to us is, I'm going to try to break down this chart to you, the market profile chart. Basically it does is gives us information about the buyers in the marketplace, about sellers in the marketplace, and tells us at any point in time whether the buyer is stronger or whether the seller is stronger. And I'm going to be walking you through how best, okay, to collect this information from this particular chart. So the first and foremost thing which is different from the way you look at a candlestick chart is, I'll again strip off the VWAP, the VPOC, and all the essentials over here, and stay basically, okay, with a candlestick chart over here. So the first thing, okay, which we look at is, this candlestick chart is good to tell us what price is doing. In fact, this is today's session, and price did nothing in the Nifty futures today, right? So it was really a flat kind of a market. But what really happens within a candlestick, when you see green, you know price is going up. And when you see an alternate green and red, okay, you know, okay, price is sliding down. Or when you see a thick set of red candles together, okay, you know, okay, price is going down. This is the way we've been used to seeing price action on a chart. So to understand this better, what we do is, like, we add indicators to it. So we add our moving averages, we add our trend lines, and we add a number of indicators to this chart. And the whole purpose of that is to find out what is happening on the chart, whether the buyer is stronger or the seller is stronger. So this is the way we've always been used to looking at charts, plotting it via candlesticks. Now, what Pete Stedelmeyer did is that he came up, okay, with this concept wherein instead of putting bars or candlesticks on a chart, he started putting alphabets A, B, C, D, E, F, G, right up to N. Okay, but there was a rule attached to it, and he called these TPOs, time, price, opportunities. Now, I'm going to give you a few words to get good at. There is a language associated with the market profile. Just like, okay, there would be language, okay, with just about anything, okay, we do. Say, suppose, okay, you are in Delhi tomorrow, there is a language associated with that city, right? You're in Mumbai, there is a language associated with the city of Mumbai. You go, okay, to Europe, okay, in Paris, okay, there is a language associated, okay, with that city in Paris. So everybody has got their own way of doing things, their own way of looking at things. And within market profile also, we have a certain language we use. So I'm going to give you a few words which we get good at it. Not very complicated, because I know, okay, we are looking at the basics over here, not a lot of complicated stuff, but a few words, okay, I'm going to give it to you, which are basic requirements of understanding a market profile chart. And the first of those words is this word called TPO, or time, price, opportunities. TPO. So short for time, price, opportunities. Now I want you to remember this word, because we're going to be talking a bit more about this particular word. So whenever we talk about a market profile chart, this word TPO is always there in a market profile chart. Now, what is this TPO? What does TPO mean? It's short for time, price, opportunity. But I don't want you to get over there. Okay, just think of TPO as a candlestick. And unlike a candlestick, what we do in a TPO is that we give it a name, and no complicated names over here. We just assign an alphabet to it. So we'll assign an alphabet A, B, C, D, E, F, G, H, I, J, right up to about 3 p.m. And I'll explain to you how we get to those alphabets. But think of TPOs as alphabets. And what we do is we arrange these alphabets in a particular set, in a particular format on a chart. Now, why do we do that? I'll explain to you. There is a mechanism to it, and it's a very good mechanism at finding out what really is happening in the market. So as you can see in this chart over here, okay, what we've done is you've seen these as alphabets. So I don't know whether you can see this. Let me see if I can zoom this chart a bit. So if I zoom this chart of today, you can see these letters A, B, C, D, E, F, G. Now there are certain rules which we have to look at. Okay, so this letter A, which is coming up right over here, is anything in the market which is beginning at 9:15 a.m. and right up to about 9:45 a.m. All the activity which happened from a 30-minute period between 9:15 a.m. and 9:45 a.m. is represented by the letter A. Okay, and there is a way of representing this letter A, and I'll come down to you in a bit. But think of TPO as 30-minute candlestick bars. We work in the 30-minute time frame. It was always the chosen time frame of the market profile, and it's a very good time frame because it helps you a lot to understand the market nuances and to understand market structure also. But essentially what really happens is that if price begins at a certain level, let's say today this was the open, and it began around, let's say this price of 19,785 today. All that works with price. Every single 1 point move of price which happened between the period 9:15 to 9:45 will be represented by the letter A. That is all that is to the meaning of the word TPO. So suppose it was at 19,750. It became 19,751, 752, 753, 754. It all goes in the alphabet A, and the chart will show up as A right over here. Everything happening before 9:45. So that's 9:15 to 9:45. And this will continue till the clock strikes 9:45, 9:44 and 59. As soon as it becomes 9:45, the alphabet changes to B. Now, whatever happens to price between 9:45 and 10:15 a.m. will be represented by the letter B. Now, bear with me. There is a lot of logic in plotting a chart this way, but essentially, in this case, price moved from 19,822 at the start of 9:45, and it went to about 19,860 today. And you can confirm that on your candlestick charts also. But everything the market did between 19,822 and 19,860, or for that matter, it could have done it to 20,000 also if price would have gone there. Because it happened between 9:45 and 10:15 a.m., it is going to be represented by the letter B. Okay. Next, we go to C, which is the period between 10:15 and 10:45. So whatever the market did between 10:15 and 10:45, we represent by the letter C. And D is everything which happened in the market between 10:45 and 11:50. So I've just got a simple Excel to show you over here about how this calculates. I'll explain to you why, but this is something you need to know, that every single half an hour in the market is represented by a letter A, B, C, D, E, F, G, right up to about 3:15 to 3:30. That is the shortest, because the market session closes at 3:30. You get the M period at the very last, which is the shortest period. It's only about 15 minutes. Technically, it should have been till about 3:45, but because the exchange closes, that's why it's a 15-minute period. But you get the message over here. Every single 30 minutes, we are giving it a name. Now, this is the point of difference between a 30-minute candlestick chart and a market profile chart. You will say, okay, yeah, okay, why am I looking at a market profile chart when I can plot a 30-minute chart of any instrument, right? And you're right, okay, you can do that also, because the 30-minute chart is giving you the same information. The high and the low and the open and the close is still going to be the same. But what really happens is the information gets stacked up in a market profile chart like this. Okay, so it's right next to each other, and because it is stacked like this, and because it has an volume, or it has an element of time to it, so that's why it's called time and price and an opportunity. It's actually a play between time and price. Okay, we get a structure which looks like this. Now, this is what I call a split profile. When I stack it, all these alphabets, when they come together right up to M, okay, will look like this. Now, this has got a lot of importance to us when we look at it. But staying okay with this first concept called TPO, we want to actually work with this concept of time plus price together. So price by itself is what we call in market profile an advertising opportunity. But when time and price come together, they give you a lot more information about what the market is doing. Now hold on to it. I'll explain to you how best we can utilize this information or this message of time plus price together. Okay, there is a lot more we will cover as we go on through this session. But the difference over here is, as opposed to only looking at price, you are adding an element of time. So that's why it's called time price opportunity. So you keep doing this right up to about K, and that is what is called the TPO of the market profile. Now, this is one word I wanted to give you. The second word I want to give you is value area. Okay, now this is also a basic building block of the market profile. And today I'm just going to give you 3 key concepts of the market profile. And if you can be clear with me on these 3 concepts, you understood about 40% of market profile. It's not complicated at all. It's a very simple language, but it needs a bit of understanding at the very beginning to get good at it, right? So the second word is value area. Now, what is a value area? The value area is this black shaded region which you see in all the profile charts. So every time you look at a profile chart, you will see a region marked in a color over here. In our charts, it's black in color. It could be any other color anywhere else. This is the second most important concept of the market profile. This is called the value area. And in the value area, you'll get something called a value area high, which is in this case of today, 19,832. And you'll get a VAL or a value area low, 19,802. And you'll also get something called a POC, which is this pink line over here, 19,807. I'll come down to that. But before that, I just want to explain to you what a value area is. See, the market profile was created to give you a statistical representation of the market activity. Okay, and that involves the core of statistics. Now, I don't know how many of you are very good in statistics in the maths aspect and all, but you may have heard, or you might have heard, this concept of standard deviation, right? I'm sure, okay, it is part of everyday life today, and all of us have at some point of time heard about standard deviation, right? The market profile is one standard deviation of the time or the volume, okay, spent during the day, volume created during the day. So in a full day, if this day today was 19,862 to about the low was 19,756 today, the region where the market traded one standard deviation or 68.6% of the time, that is called the value area. Now hold on, okay, to this thought, okay, for some time, because we are going to be exploring, okay, this concept in a lot more detail. We'll just brush over, okay, some basics, but I'll explain to you, okay, why we are looking at that one standard deviation. So if you ask anybody who is good in statistics, he will tell you, okay, what one standard deviation is. One standard deviation is also called a normal distribution, and it means that the market is accepted as fair within that standard deviation, right? So I just want you to go back, if you're new, okay, to this concept, and Google this term called standard deviation, and it will tell you a lot, okay, about what the market intends to do. Now, what actually happened around the time Pete Stedelmeyer was trading, the markets were a lot quiet. Okay, they never used to trade a lot. We in 2023 are working in extremely fast markets, right? And if you trade it today, okay, was an example of a very slow market. But if you saw yesterday, Nifty futures, same instrument, we were up and down in the last 1 hour of trade. Now, that is an example of a very fast activity. Back in the day, about 50 years back, Pete Stedelmeyer and his team never got to see these kind of moves. And they used to make their money completely off this concept called the value area. At that point of time, this was almost a holy grail for them. Okay, the markets used to be so quiet that they used to know that every time the market went to value area high, it was a short. It was a short. And every time the market went to value area low, it was a long. That's all that they did, and that's all the strategy they devised to trade this. So that's why, okay, this market profile became very popular, because they used to pull up all this data and they used to just plot this value area high and the value area low. And they knew that whenever, okay, price approached the value area low, that was the time to buy. And whenever the price approached the value area high, that was a time to short. It's no longer the case today, but it's got utility for us. Today, the markets have become so fast that the market does not stay in the value area like it used to. Back in the day, 50 years back, like I said, the market moved within the value area about 90-95% of the time. Today, very rarely it stays in the value area. But that has not stopped us from collecting opportunities from the market, from taking care of opportunities or exploiting information from the market, right? So what did I just tell you? Every time it went up to value area high within a normal distribution, it was a short. And every time it went to value area low within a normal distribution, it was a long. But what really happened above the value area high? What really happened above the value area high? Every time price, okay, showed acceptance, and I'll use that word again, acceptance, and we have to, okay, use this word carefully, because acceptance, okay, today is measured in terms of volumes, right? So acceptance means price, okay, is getting up and above that level, and it is getting confirmed by volume. Every time price started moving away from value area, it created a move higher, which is what we saw yesterday. And we came to the understanding that buyers rule the area above value area high, right? So if you had to look at a chart, a market profile chart, and just look at this chart and see or try to find out what to do in this market, I would look at today's chart, and based on this concept of value area, it is in the value area of yesterday. See, this is yesterday's value area, right? And today we are trading completely in the value area of yesterday. So this is a flat market because it stayed in the value area of yesterday. I will not do any big directional trade because we are trading in the value area of yesterday. But in the morning yesterday, it took out the value area high of yesterday quickly and cleanly. And you can say that the buyers were in control all of yesterday, right? So what we are doing is we are arriving at a bias to explore a decision making information for us. So immediately, as soon as you see the market is above the value of the previous day, you can infer that the buyers are more in control, and the bias you need to do is on the long side. If it's in the value area of the previous day, then it says it's a sideways zone. And if it is below the value area low of the day, then it is a seller's market. The bias, okay, belongs to the seller, right? So these are two concepts. So far, so good, I hope. One is TPO, time price opportunity. Second is the understanding of value area. And remember, value area is the zone where the market has traded 68.6% of the volume the other day, right? Now, come back, okay, with me to a third concept of the market profile, which is called the POC, the point of control. Let's understand, okay, what the POC is, right? So in all our charts, you'll get this thing called VPOC, which is currently of today at about 19,807, and of yesterday it is at about 19,853. Okay, now what is this VPOC? So VPOC is a region, a zone within the value area of the profile, within the value area of the profile, and it represents the zone where the market traded the maximum volume. It represents the zone where the market traded the maximum volume, right? Now, this is another indicator of bias for us, because even though today's market was below or in the value area of yesterday, you can see immediately it was below the POC of yesterday, right? So majority of trade happened at this pink line yesterday. Majority of trade, most of the market activity happened at this zone. So a lot of traders, okay, will tell you there was a lot of buying in the market, there was a lot of selling in the market. But the more critical information is, where did the majority of the market trade that way, that day? And if you look at the POC, and you can confirm it, okay, with any information you have of any candlestick chart or etc., the most critical information is, where is the POC? POC is called the point of control, or represents the zone where the maximum volume got traded in that particular day. By inference, or to draw a logical calculation or conclusion, okay, from this, you can say again that this market is stronger above the POC and weaker below the POC, right? So this becomes a first bias point, and the exit of value becomes the second bias point for us. So even though we are saying sideways over here today, this market is actually slightly, okay, seller dominated today, because the market did not go above the majority of trade yesterday. Now, how is this information useful? This is extremely useful for us when we are trading 19,500 CE chart, right? So this is the same. Now, of course, okay, the volume in the options market, like I've been saying, is a lot more higher than the volume in the futures market. This is the 19,500 CE of today. So this is the POC of yesterday, around 258. This is the 23rd November. And you can see this market, okay, stopped right here at 257, and it went further up, right? So this again becomes a critical point for us. This is actually, okay, a little bit of different information, okay, for us, okay, to keep track of. But because it was a sideways zone within here, again, okay, you can see, okay, how much importance the market is giving to this one parameter of the market, POC. Now this low over here is not just a random level, it is the POC of the previous day and the zone, okay, where the market traded the maximum volume. That's why, okay, the market has got stopped over here. And this pink over here is a POC, okay, from a previous day's profile, and that's why, okay, the market got stopped over here. So what we're trying to do over here is, using the market profile, we are trying to work with a lot more parameters than the open, high, low, and close of a bar. So what we've added is something called a value area. What we've added is something called a POC, which is the zone where the maximum volume got traded. Now, are we not better placed information wise than any trader who's just looking at open, high, low, and close, right? I've gotten on the same chart and on the same 30-minute time frame, I've gotten to know a little bit more about what the market information, what is the information the market is giving us. And our job as traders is just to collect information from the market and monetize this information. And the better we get at collecting information from the market, the more, okay, we'll be in a position to monetize the information which is coming to us. There's no other role for us as traders. Our roles are only to observe information, understand information, and monetize that information. And the better we get at collecting information from the markets, the faster, okay, we get at developing ourselves as traders, right? So 3 concepts. One is TPO, one is value area, and the third concept is POC. Now VWAP is a very popular term. This is represented by the green color over here. That is there in all the profiles. We call each of these individual candles a profile. So this is a daily candle for you. For us, okay, we call it a profile, a daily profile. And for this daily profile, besides the high and the low, we have the POC, largest concentration of volume. We also have a second POC, which we call the HVN, which is the second biggest concentration of volume. And we have the VWAP represented by this green line over here, right? So this is the information which is giving to us. Now, the second bit of information in this market profile chart will give you is the shape of the profile, right? So just like how you have different candles, higher wicks, wicks, lower wicks, wick, the wick, WICK, higher wick, lower wick, higher body, lower body, narrow body, short body, like that, okay, we have different kinds of profile structures also, right? And because, okay, these structures are different, we call them fat profiles, we call them elongated profiles. They tell us a little bit more about what the market is doing. So yesterday I said the market was dominated by buyers. And if I go back to the Nifty, now the instrument over here is not that important. The idea is over here is to understand the information which the market is giving us. So I said that the buyer was in control yesterday in this particular profile. So it was a buyer dominated profile, and for some reason, okay, which is there, okay, at the left of this chart, there was a small gap area and the market showed some profit booking over here and it came off. So that is what happened, and today, okay, we opened up lower, right? But we are still in the value area of yesterday. So you can say that the trend of the day or the trend of the chart is not yet changed, right? Now, just looking at this structure, if I just zoom in, if I have an understanding, I'll just make the chart small. So this is, okay, the chart of the Nifty, and it's gone from this value area at 19,500 to a gap up here and higher, and today it is sideways. So one of the rules of market profile is, as long as value is created higher, the trend is higher, right? Let me repeat that. As long as value is created higher, the trend is higher. Now, we don't run after price. We look at value. There is a big difference, okay, in understanding those two words. So one is price, one is value. And if you as a trader are focused on understanding where the value of the market is and what the market is doing in relation to that value, you're picking up a little bit more information from the market. So what we say is price advertises opportunity. The job of price is just to move up and down. Okay, it's just to advertise an opportunity in the markets. The idea behind being a good trader is to know that price is doing its bit. It's doing that dancing, okay, trying to attract us. But are we, okay, getting into a good place to execute, okay, on what price is telling us to do? And the best way to execute based on what price is doing is to be understanding the value where it is created. So as long as value is created higher, like between the previous day and today, this is a higher value. So we shift, okay, buyers and become buyers. But if value gets created lower for some reason on Monday, then the bias of that day is going to be lower. If for some reason the bias comes here, then because it's the value below the value area of this particular profile, it's going to become lower. And the profile after that, if it goes lower, then okay, you can say there's been a small shift in trend because now value is shifting lower, right? So if you are the kind of person, okay, who's looking always, okay, to spot changes of trend, you will, okay, look at the positions of value, okay, and you will say that, okay, now value was going up, now it's gone sideways, so buyers, okay, have lost some momentum over here. But does not mean that the seller is come back yet, because there is no value going lower, right? So any bet, okay, on the sell side over here is aggressive because there is no confirmation of a trend change happening, right? And you can go back and look at this lower also. So end of last series, okay, the market, okay, was drifting lower, right? And it went lower, 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 and there was this value area, okay, forming sideways. Then suddenly, okay, we created value higher in this profile. This was the first value which was created higher amongst all this cluster which was moving lower. And then the second value, okay, created higher over here, and you can say the trend changed and we started moving higher. This is 19330. This is how, okay, they used to trade market profile and work on trends. But what they did was, okay, they were very, very clear about how to position themselves in the market. So even though, okay, they were not picking up the tops and the bottoms, at least, okay, they were getting the majority of the rest of the trade right. Right. So it's not, okay, about picking the bottoms. It's not about picking the tops. It's about, okay, what you're doing in between, okay, that matters as a trader. So leave the tops and the bottoms, okay, for the other traders. But what we want to do is avoid the stupidity between the tops and the bottoms. And if we can get clear ideas about what to do when the market is in between the high and the low, that is, okay, the time, okay, we can collect more information from the markets. Right now, there is a lot more, okay, we can glean, okay, from the market profile. I'll just give you, okay, a few more examples about what you need to look at in these charts. So let me just go back to the most current profile, which is today. So you'll see these two profiles over here. The one on the left is an elongated profile. This always happens in what we call a trend day structure. And this one over here is what we call a balanced profile. Okay. Now, what really happens? This profile is because buyers and sellers were matched in a particular range. So you saw, okay, today's market, okay, was mostly sideways. And that sideways range was because the buying strength and the selling strength was more or less equal. Now, contrast that to what happened yesterday. I said already that because we were above the value area high, the buyer was in control. So yesterday's profile is elongated because yesterday was a buy-dominated profile, buyer-dominated profile. And it creates, okay, what we call a trend day. Right? Now, there are a number of ways, okay, where you can be good at finding out what actually can happen. One of the better ways to do that is to find out what is happening in the opening 15 or 20 minutes of trade. So a slightly advanced concept of the market profile is to know what is an open type. right? So if you're on Twitter, you're following me, you must have heard me say words like OAOR, OAIR, OD, Open Drive, Open Test Drive, Open Rejection Reverse, ORR, etc. So these are variations of what really can happen in a open. Now, every time the market opens and goes beyond the value area and range, we know, okay, that there is an opportunity to be a directional long gamma player, a directional long trader. And if the market opens and stays in the range and the value area of the previous day, that's not the time to pick up a lot in terms of directional activities, or not the time, okay, to look at those quick 100 or 200 point moves. So I will definitely trade a big CE long or a P long over here, because, okay, we are exiting value. But I will not look for a big long trade over here or a short trade, because I know the market is not going to give me those 100, 200 points, because it still has not exited value. This can be found out, okay, at the open, right? Now, I don't want to get a lot of this additional information to you, because, okay, you need to build on this over a period of time and get good at it, okay? But there are a lot of places where you can go and pick up this information. So one, okay, link I highly recommend is you look at this link, which is what is the market profile. If you can just jot it down somewhere, you go to vtrender and you just zoom in, or you can just Google it, vtrender, what is a market profile. This will explain to you a lot about what the market profile is. And there is a lot of the terms we use, the value area, buyers, sellers, all these terms are also explained over here, together with a lot of other links where you can get to know what the structure, etc., of the market is, right? And there are a lot of links like that. There is what we call the most read section, where you can, okay, see a little bit more about what the terminology of the market is. So point of control, developing point of control, excess, poor highs, poor lows. If you can go through all this, there is a lot more, okay, on the right side of all these posts. Then there is something called the day types: the normal day, the normal variation day, neutral day, non-trend day, trend day, double distribution trend day. Now, I hope to cover all of these with you when we go down. But essentially, I wanted to, okay, talk to you, okay, about what the structure of the market is, what the value area of the market is, and how to position yourself. Now, there are a number of trade opportunities, okay, which come to us, okay, when we are just looking at these parameters of TPOs, etc. Now, even with that TPO, the word, okay, we discuss, try to understand the TPO as something which is not the same across the session. Okay, the TPOs have also got different weights, and they have different weightages. Now think of this as like your Nifty index, for example, your Nifty 50. In Nifty 50, there are 50 stocks, but the weight of all those 50 stocks is different, right? So if the rest of the market is quiet and your Reliance, okay, starts moving up, what do you think is going to happen to the Nifty? Right, the Nifty is also going to start moving up, because the weight of Reliance is that much more heavier. It's not equally distributed. It's not equal across the entire 50 stocks. The same way with all these TPOs, A, B, C, D, E, F, G, they have got different weights. And the most important ones are A, B, G, K, and L. And the one, okay, right at the end, M and N, because that's a closing, right? So we say that A and B is where the institution comes in. G is the time, okay, the institution adjusts his inventory if he's caught on the wrong side. And K is what we call the killer wave, the killer move, where a lot of big trending moves, okay, keep happening. So the weightages are different. Okay, so we as traders, as market profile traders, do not, okay, actually, okay, look for a big swinging move in that D period, which is between 10:45 to about 11:15 a.m., or the E period, which is between 11:15 to 11:45. So what we are doing over here is we are not just, okay, looking at price. We are trying to understand price in relation to time. Okay, and when we understand price in relation to time, the structure of the market, okay, becomes a little bit more clearer to us, right? So for example, we call C, the period between 10:15 to 10:45, we call this a dhoka period. So C is technically, okay, known for failed moves, So that's where, okay, that concept of the failed auction, okay, also originates from. And there are a lot of other concepts, okay, like extension handles, failed auctions, etc. But in C, which is the period between 10:15 to 10:45, always, okay, try to look for a mean revert trade. Like I think it was today we were looking at the bank Nifty. So bank Nifty, okay, had that big gap down. No thanks, okay, to what happened in the RBI today. And this is the C period. It went down, but immediately it popped right back, okay, up to about 43,890, right? So this is, okay, what we call a move not to trade, to be very wary of, because, okay, it came in the period between 10:15 to 10:45. So we call this a dhoka period. We call this a period, okay, fraught with a lot of anxiety, lot of risk for a trader, okay, who is trading the markets. We never try to chase a move in the C period. We try to, okay, stay away. In fact, okay, on the contrary, okay, we look for mean revert trades, because every time there's a good possibility that every move in C can revert back to VWAP most of the time. This is a classic setup we have, and which we use only for this period between 10:15 to 10:45. Like this, okay, we have a lot of other moves also. Most of the decisive moves happen in the K period. So today, okay, was a quieter day. But if they do not happen in the A and B, then they can happen either in G or in the K period. So this is how, okay, you utilize TPO. And there are a number of other things, okay, which I intend, okay, to cover with you as we go along. Today, basically, I wanted to talk to you about understanding market profile. But no, okay, that market profile is for understanding the finer nuances of the market. It's for understanding, okay, market structure. It's for you, okay, to get to know what to do with the information the markets are giving us, right? So if you want to go deeper into this, I highly recommend, okay, that you register at charts.vtrender.com for a market profile chart. These charts, okay, which I showed you, we have them as a free access also. Okay, you can, okay, pick up free access, and you can have most of the higher time frames also. You can look at it end of day, scrutinize the market, get good to understand what the market is trying to tell you, right? And if you want to go deeper, then there is, okay, of course, okay, live data available, which we use at, and it's for a nominal, okay, about 354 every month. You can, okay, get live streaming data of these market profile charts also. But more than, okay, getting this information, it's about how best, okay, you can utilize that information. And for that, okay, there is a little bit of work involved for you to get better. But the key point over here is that you are looking to pick up information from the markets, right? The market is always giving you information. It's your job as a trader to read this information. And the better you get at reading information from the markets, okay, the more you're going to be progressing on to becoming a better trader, right? So this was all about market profile. I hope, okay, it was informative for all of you. Like I said, okay, keep an eye out for us for the second part of this series. We are going to be going a lot more deeper into market profile, and I'll be walking you through how to understand which profile to look at, which some or all, not all of these profiles are the same. It's like the 5 fingers, okay, of your hand. Not every single finger is the same. So we don't walk into any day expecting the same kind of result. The market is different on different days of the week. But a good understanding of market profile structure will tell you the next day is going to be quiet. Like in the morning today, I knew, okay, because of the larger trend day today was going to be a quiet day. And we spoke about it in the mentoring room also. And it turned out to be a quiet day. This is because, okay, I understand, okay, that the market, okay, goes quiet after a big range. I want all of you, okay, to get good at understanding this bit of information. There is a lot within this profile for the next day also. We will cover ground on how to use the shape of these profiles. We will cover ground on how to use the information within each of these TPOs, which one is a support and where it is likely that the market is going to get resistance. We will cover how to look at concepts like extensions, like failed auctions, like how to spot a trend day before the rest of the market gets to know it's a trend day. Those are all concepts which are deep buried into these charts, and you'll have to spend time and let these markets speak to you, let these charts speak to you, to find out really that they can communicate to you. So it's a two-way relationship. You'll have to spend time with it. You'll have to get to understand it. Eventually it is going to speak to you also, right? So if you want to go deeper, look up all these links on the most read post. You can look up the forum section. We have a lot of posts over there, and my colleague Uttam, he does an excellent report every morning on the entire market profile, the open types, the initial balance, the date types. These are bare basics which I feel all of us should look at. So we cover the Nifty and the Bank Nifty, and Uttam has promised me that he will do the Fin Nifty and the Mid Cap Nifty also for all of the settlement days also. So we look forward to that, and you can have a look at all of these articles in the forum. To the right of them, you will get some of our more popular posts, and you can have a look at all of them also, right? So I'll leave you to it. If you have any questions, keep it coming. You can speak to us. You can chat me up on Twitter. We will be following up this session with another one on market profile the coming Tuesday. That will also be at 5 p.m. and next Friday we will cover some more basics of this. So before I end, I just wanted to show you an order flow chart also. So for those who have not seen an order flow chart before, this is an order flow chart. This is of the Nifty. You can do an order flow of just about any option also today, call, put, whatever, and you can choose the time frame of your choice also. Now, what is order flow? Order flow is nothing but level 2 of market profile. Level 2 of market profile. So it's a higher understanding of market profile. So unfortunately, back in the day, Pete Stedelmeyer and his team did not have volume information. They did not trade. They did not know what is the kind of. So only when electronic markets began that the market started giving volume information to traders, right? So we are picking up all the volume which is coming in, and this is not just any volume. This is traded volume. So this is money. This is all in number of lots. This is money which is in the chart, right? So this is not something in the order book where a trader is threatening to come in or is planning to come in but is not yet come. We don't work with that. We don't look at the order book. We look at the traded quantity, right? The position already in the market, because when this position is already in the market, this changes everything. This changes everything, right? So you planning to come 100 lots in the market, you are all hunky, very well settled. You're happy, that you made a plan, you have a strategy and everything, and your 100 lots are waiting to come into the market, right? After your 100 lots come in, and assuming you got a 100 lot short, and if the market goes 50 points up, immediately 2 minutes after your entry, your entire strategy goes for a toss, right? Your entire planning goes for a toss. Now you are caught upside down and you have to make a hasty exit because it went under your trade. So those 100 lots which came because you went upside down, it changes and it creates another flow into the market. That is why we don't work with the order book. We work with traded quantity, because what is in the market makes the market. What is in the market, what is already traded in the market, leads to those sweaty palms, sweaty hands, and can force price moves to happen. So always remember, it's a traded quantity which moves market, not the quantity which is coming in. So all these are quantities on the trade, and I'll be talking to you about how best to utilize this information from the market. So like today we saw in the market profile chart, it was a nothing day. All this green and all this red do not mean anything. because there is no imbalance over here to say, okay, that the market, okay, wanted to do anything. But I'll be walking you through, okay, how best, okay, you can look at the order flow chart also and pick up information which is coming from the market, right? So we always say there is noise and there is voice, and our job as traders is to pick up the voice from the market, right? And we will also cover the options market, especially, okay, the gamma, etc., of our charts. This will also be a program coming up. I'll talk to you a bit more, okay, about how to utilize this concept of gamma to again, okay, arrive at a better trading decision. So all this is coming up. So to keep a ear out, okay, for us, okay, we are planning to do this on every Tuesday and every Friday, 5 p.m. If you can join up, okay, nothing like it, okay, we can always discuss this, okay, about how best, okay, we can proceed this proceed with this forward, right? So I leave you with it. Remember, information is potential power, and it's up to you to maximize the information which your charts are giving you. Your charts are of no use to you if they do not supply information, and without this information you cannot monetize, right? So get good at collecting information, get good at monetizing. I wish you all a very good weekend, and there is a good cricket match coming up, so I wish India also the very best, and we should be winners, okay, of this ICC World Cup 2023. So let's all, okay, cheer, okay, for our team also this coming Sunday. But with that, okay, it's a good weekend to all of us. Enjoy, okay, our weekend, and I'll see you bright and early on Monday morning. Thank you for signing up today, guys.